Before you buy a house, I need you to see something. Because this, right here, this is how people accidentally trap themselves in 30 years of financial stress. It's not about the house, it's about the mortgage calculator you're using. And no, this is not boring. This is the difference between building wealth and being house poor for decades. The big mistake most people make. Here's what usually happens. You go on Zillow, you find a house you like, let's say it's $450,000. You click that little estimate payment button, you put 10% down, you leave the interest rate at whatever default number it shows, and boom, it says estimated monthly payment $2,100. And you think, okay, I can handle $2,100. So you move forward. You get pre-approved, you make an offer, you're excited, then closing day comes, and suddenly the real numbers show up. Principal and interest? Sure, $2,100. But now add property taxes, insurance, PMI, HOA fees, and just like that, your $2,100 payment turns into $3,300 plus. And you're sitting there thinking, wait, what just happened? Personal story, more emotional tone. This happened to me. I was 26, saved about $25,000, bought a $280,000 townhouse. The calculator said $1,650 a month. I thought I was good. At closing, $2,340. That's almost $700 more than I planned. Every month. For the first 2 years, I was stressed constantly. Couldn't save, couldn't relax, couldn't even enjoy the house. I wasn't bad at math, I just didn't see the full picture. And that's what I don't want happening to you. What basic calculators don't show. Most calculators only show principal and interest, but your real payment includes property taxes, which can be hundreds per month, insurance, especially high in states like Florida or California, PMI if you put less than 20% down, HOA fees, which can quietly add another few hundred, and maintenance. Nobody talks about maintenance. The rule is about 1% of the home's value per year. On a $450,000 house, that's $4,500 per year. That's $375 a month. Your roof doesn't care what the calculator said. Real example, clear, slow, powerful. Let's break this down. $450,000 house, 10% down. Loan, $405,000. Interest rate, 6.5%. Basic calculator says $2,560. Sounds manageable, but here's the real breakdown. $2,560 principal and interest, $563 in taxes, $200 insurance, $270 PMI, $150 HOA, and $375 maintenance. Real monthly cost, $4,118. That's over $1,500 more than what most people budget for. That's not small, that's life-changing. What you should use instead. Use full mortgage calculators, the ones that let you add taxes, insurance, PMI, HOA, and don't use fake interest rates. Look up your real local property tax rate, get a real insurance quote, run multiple scenarios, because the more accurate your inputs, the safer your decision. The 28% rule, reality check tone. Here's the rule lenders use. Your total housing payment should not exceed 28% of your gross income. Let's say you make $90,000 a year. That's $7,500 a month gross. 28% of that, $2,100. But we just calculated $4,118. To comfortably afford that house, you'd need to make around $176,000 per year. That's the difference between what feels affordable and what actually is. Final reality talk. Slow, serious, empathetic. I'm not trying to kill your dream. I just don't want you stuck, because being house poor is brutal. You can't switch jobs, you can't invest, you panic over every repair, and that stress follows you every single month. So before you fall in love with a house, fall in love with the math. If the numbers don't work, wait. Waiting is cheaper than regret. Trust me.